Moody's recognised positive developments in the area of structural reform in energy and logistics, for example, but said its decision to keep the Ba2 long-term issuer credit rating was due to what it sees as low potential growth as a result of an ageing infrastructure network, a weak labour market and socio-economic inequalities. Dr. Elna Moolman, head of SA Macroeconomic Fixed Income and Currency Research at Standard Bank South Africa, unpacks her observations.
Moody's acknowledges the reforms that South Africa has implemented over the last few years in the electricity and logistics sectors, for example. But the agency remains quite cautious about South Africa's economic growth rate and argues that we haven't really seen an improvement in South Africa's economic growth despite these reforms. They also highlight that we haven't seen a meaningful increase in private sector fixed investment despite the reforms.
Moody's also highlighted the fiscal drain potential of state-owned enterprises like Transnet, which has debt in excess of 130 billion rand.
It therefore includes some of the guarantees to SOEs in its estimates of government's debt levels. In other words, it argues that there's a high probability that government would have to provide funding to the SOEs at some stage.
The ratings agency said it would be looking closely at the country's economic growth levels and the sustainability thereof, as well as improved fiscal matrix before being confident enough to make any moves on the country's credit rating in future. Nampumelo Siziba, SABC News, Johannesburg.